Yep. Hi, everyone. It's very, very good to be back here at Macquarie. This is the first time I've been here since I graduated, which was in 2005. So it has changed somewhat. I was lucky that Lara gave me a tour to explain where everything was, but absolutely great to be back and very exciting to be on campus. So yeah, we're going to talk about fundraising and revenue, the two things. If you're a founder, if you're in the startup business, that's what you're thinking about all day. That's the point of your business. We'll start. I'm going to tell you about a startup that I'm working on at the moment out here in the desert. So this is the Interstate Highway I-40 in Arizona. We're looking east towards New Mexico here. And this is a fantastic place for data centers and all kinds of infrastructure. So last November, I founded a company, and I've never spoken about it publicly until now. So this is a worldwide debut. But we are actually building a beautiful piece of infrastructure here in Arizona. It's called Project Red Sands. It is a 400-mile fiber network connecting to a 3 megawatt data center. So my company specifically doing the AI infrastructure, the fiber network. We're raising like equity at the moment. We're just doing a $25 million round, but the total cost will be about $270 million. And I'm not saying that's where everyone should start. I built up to that, but it's very credible. If you want to do big projects, if I can do it, anyone can. But yeah, this is very exciting. We're going to start construction in the US summer in June. But yeah, super exciting project. That's just a little something I'm working on that I wanted to share with you guys. So how did I get here? Just a quick overview. I don't want to give a recitation of my resume or anything. That's boring. But basically, I started in corporate. And, the whole system, there never was really a thing called entrepreneurship. There never was an idea of startups when I was growing up in Australia in the 80s and 90s. It was really, get a job, be in corporate. Like I said, I did an MBA here.
Okay.
I don't think entrepreneurship was really mentioned once. It was all about, being an administrator and manager of someone else's company. That was the point of that course.
Right.
But somehow, it was a pretty good education. I think big companies teach you how to do things well, how to work within systems and so forth. But for some reason, I ended up at a startup, and it happened to be in Hong Kong. So my entire entrepreneurial career has been overseas. So I was employee number 7 as an Australian working for a Swedish startup in Hong Kong. Very long story as to how that happened, but very interesting nonetheless. We were in the video software space. We really rode the wave of Netflix and HBO and so forth. They were customers. But anyway, we grew the business. I was employee number 7. We grew it to 450 people over time. I was there for 8 years. I was in Hong Kong for 4 years. Then they said, let's open up the US. So I opened an office in Silicon Valley in New York and Los Angeles and Guadalajara in Mexico. Absolutely fantastic time. So yeah, we ended up selling that to a private equity firm after about 8 years. So a really good outcome, I thought. But I'm too far gone from the corporate world, so there's nothing you can do except another startup. So that's what I did. Was actually the CEO of a startup that spun out of NICTA, or Data 61, the CSIRO program for a little while. And I was in Silicon Valley for 11 years, so raising money nonstop. I literally have been raising money for 20 years, pretty much, yeah, without fail. The only thing now is you can get Claude to do your decks. I mean, that's really improved efficiency somewhat, but it doesn't get any easier. So I've had a long period in the US, and then I wanted to come back and have my kids finish their school in Australia. Hopefully get rid of their American accents to some degree. It's not really working, but so I'm back here now, but I haven't stopped doing startups. I have one in Hong Kong in the real estate space, and like I said, my Arizona project. So a lot of more failures than success, but you only need a couple of successes in this business. It is a tough game, and I commend you all if you are startups and CEOs of companies. That it's a tough path, but it's important work that you're all doing. So my definition of an entrepreneur, is someone whose ambitions exceed their resources. What that means, like if you want to do something, you want to change the world, impact an industry, um, even impact, an economy. You have very, very big dreams, big plans. You're never going to have enough resources on hand to do that. So the whole point of entrepreneurship is convincing other people to give you those resources to get those goals achieved. So that's the lens at which I view it. I know there's other things around it, but this is kind of the theme of my talk today. So as I mentioned, capital is global. I haven't really raised money in Australia before. I would like to. I was saying to Lara before this, I mean, we're going to have the second largest pool of retirement savings in the world in about 4 years. So we have this enormous, deep pool of capital. It would be very nice if it just wasn't so conservative and was able to maybe put a fraction of a percent into some earlier stage companies and take some riskier bets. But our superannuation pool is a massive asset. Having said that, deep experience in Sand Hill Road, in Silicon Valley and New York, of course. The Middle East is my favorite place to raise money at the moment, especially as you get into debt and large scale projects. And then Asia, it's a different market up there. It is more conservative. They like real assets. They think generationally a lot of the time. So you need a different story. Pretty much for each one you're working to, but it really depends on your business, right? So I'm going to be speaking from my perspective. Hopefully there's some things you can take on. So this is a fundamental thing that I wish I'd learned sooner, and I hope you all go away from this talk. So I never started to raise serious money, serious capital until I started thinking like an investor. It's like you are working very hard to be an expert in robotics or healthcare or finance or whatever industry you're in. But you need to have this parallel track when you're sitting there talking to investors to think how they think. So no matter how dazzling your pitch, how groundbreaking the technology, how generationally impactful it will be, your startup is going to be put into a spreadsheet, into a financial model, and it's going to spit out a number at the end, whether it's an IRR or some other calculation, and it's going to be balancing with the portfolio that they're investing in. And if you don't understand this process and can't sort of think from how they're going to be thinking about your particular deal, you're starting a long way behind. So, I know you guys are probably out there pitching to angels, to VCs, to family offices, to all sorts of people. They all have their own investment style. They all have their own investment language. And the numbers that are important to them. I mean, for the larger funds, for the things I do now, it's all about the internal rate of return. They're benchmarking against a certain hurdle rate. It's got to be greater than that, or they're not even going to consider it. If I'm an angel, it's all about a multiple of what I put in, and a lot of investments won't work in that. Of course, the more detailed aspects of your financial model. So definitely think about, once you've targeted your investors, really understand how they think and how their business works. Really, really important. So what does capital care about? What investors really care about? And this is, across the board. This will apply in Australia as well, but, definitely in the US. So what they care about, it's not what you think particularly, but it's like, is your business something that scales? Like something that I also probably learned the hard way is not every business should take external capital, should be pitching to VCs. And that doesn't mean it's not a great business. It doesn't mean it's going to not make you a lot of money as a founder or an owner of that business. It just means that VC is a specific business model that requires a couple of hits and a whole lot of misses for their economics to work. And, figuring that out early on, and more often than not, it's a function of scale. So is it going to be a big business? And big, it's going to be 100 million, 200, 500 million. Or is it going to be, I don't like the term lifestyle business. I think it's derogatory, but, is it going to be a business that makes $6 million, $10 million and throws off 20% EBITDA? That's a fantastic business to own and grow like 2 or 5% a year, but it's not a VC investable business. But it's still a good business. Secondly, can you execute? It's very easy. Well, it's not easy. Pitching is hard, but you sustain your your story and you can work under pressure during the pitching process, but can you do it for the years on end that it requires? And every time your business reaches another growth level, it will break. So the model that worked at 10 people won't work at 25 people. When you get to 50 people, when you get to $10 million in revenue. So you have to scale yourself as a founder as well. A lot of founders don't, and they either tap out and get someone else to do it, or unfortunately, investors move them on. But you have to be the person. It's a very rare founder that goes the whole cycle. Is there a path to real cash flow? I mean, that's obvious, but it's good to be growing at 10% a month. Everyone wants that, but you also want to be making that profitably. If you're getting $1 revenue and it's costing $1.20 in expenses, it's not a great business. And this last thing, investors are thinking about risk. They're risk managers at the end of the day. They have investors too, they have to answer to. So what structures in place are they putting in place to protect their downside? It matters a lot more to investors probably than you, but you don't want to end up not controlling your business. That's obviously a downside. So all of us investors look through three lenses. So the return, as I mentioned, isn't going to be something that is worth putting money. But then they spend a lot of time on 2 and 3. What are the risks? And, what control rights do you have? And as a founder, you want to be thoughtful about how you've worked through risk. You want to show that, in your financial models that you've all developed, a base case, but also a downside case and a optimistic case as well. But you really want to be thinking about, because this is how investors think. They're thinking, well, this family office, this sovereign wealth fund has given me $100 million to invest and get I've promised them a 15% IRR. So is this company going to do that in a way that meets our risk parameters? So really important. And then control. So you don't want to lose control of your business, obviously. You want to make the decision when to sell, when to raise money. You never want to lose control. But obviously, a lot of the terms that are embedded in term sheets are very investor friendly and could see you losing control. We'll talk about that. So yeah, so you want to be not only pitching your return, but show how you've thought about these aspects as well. Now, capital has a personality. So I imagine if you're founders in this room, you're pitching to angels and VCs. Yep. Is anyone talking to family offices? This is a huge pool of capital, which I love. It's fantastic. Very, very sophisticated and prevalent in the US now. People who are managing $500 to $1 billion. Very, very a fantastic place to invest or receive funds from. But just to talk through them. So VCs, obviously, they want the growth. They need the 100x return. They want to own the upside. Family offices, because they don't have someone else to answer to, it's like their own money, essentially. It's permanent, it's patient capital, I should say. But it's they can do deals very quickly. It's relationship based. But having said that, they are looking at a whole bunch of deals. So when you're pitching to a family office, you're pitching to every other thing in the world, whether it's crypto, real estate, anthropic secondaries, anything that these guys can get hold of. So, you have to bear that in mind. You really have to stand out amongst every investment in the world. That's what you're competing with, not just people in your particular industry, but everything. Having said that, a very, very good source that if you can get in front of, there are a couple of family offices now in Australia that are more getting more sophisticated, particularly in Melbourne, but I think it's still very nascent. But it's coming. And then the infrastructure side and credit side, and I'd put superannuation funds in this as well. So, all about downside protection, very, very conservative. I will talk about debt in a minute, but I really like debt as a capital source as well as equity. But these are the guys you're talking to when you have cash flows, you maybe have real assets, and you can prove that, you have a viable business. But each one of these requires their own pitch. So, I'm sure, is anyone raising money now? Anyone knows? One? Only one of you? What are the rest of you doing here? So the best time to raise money, right? Of course, like anything in life, is when you don't need it. And that's all about, the revenue side of things. Fundraising should be a process, right? Like anything. I think people start their fundraising process and go, okay, well, we're going out for our seed fund, we're going out for our Series A. They don't really formalize it and say, okay, well, this is starting on the 1st of May. It's going to run for 90 days. I'm going to speak to these 16 investors, get down to a short list, pitch these 8, maybe get term sheets off 3. But that's how you should think about it. Like, you should really be in control of the process. But if you don't have revenue and you don't have that growth, obviously you have less control. You're more at the mercy of people, getting back to you and so forth. But, if you are pre-revenue, you are asking for money and you have to really take their terms. There's not much you can do about it. But if you have revenue, then you are actually generally negotiating and you set the terms. And just to make a point, right? So it's not necessarily bad one way or the other. Like, if it's your first or second startup, most of them don't, go out to create $100 million exit for the founders. It's more important, I think, if you are early on in the startup game, to get the company up and running and funded by whatever means possible and make it a success. And then, think about financial outcomes on the next startup or the one after that. Like, I certainly, it took a long time for me and a lot of ups and downs to get to the point where we can comfortably go out and raise like a $25 million equity and Series A and, close it in about 4 weeks. But, it's possible, but it takes a long time to get to that point. And I would say be less hung up about, the specific financial outcome you're going to get, and more focused on, okay, make this business successful, get it to the finish line, create a company, because that does wonders. That's such a rare thing anyway. It's such a rare thing. It's rare to get funded, but to get funded and then to take it on to be a successful business. But yeah, so make sure you've got paying customers in some way or another. If you're in the enterprise space and you're selling to big companies, they see you coming because they will say, oh, here's a little company. The deal won't look particularly pretty, but proving that an enterprise customer will pay is so critical. Then, once you get a few, because they know you need the logo, you need the proof point to show your investors, but, down the track that becomes easier. And in consumer, obviously, it's just about acquiring those first customers in a reasonably profitable way. So a little bit more about capital structure and control. So equity is what everyone raises first. It's the most expensive capital, obviously. You're giving away a big piece of the company. There are products in Australia now around venture debt. I'm not sure if you've seen them. You do need cash flows to support it. And obviously, if you miss a couple of repayments, then they're coming for your company. But don't write off debt. If you can, at some point, think about it. Equity is great, but I do think that not traditional debt, but there are venture debt products that maybe come with warrants and stuff as well. But I would seriously look at that. Everyone's seen the term sheets with nasty terms about liquidation preferences and everything else. You just have to be very careful when you get a term sheet. Don't just give it to Claude or ChatGPT. Get a real attorney to look at it. I can't stress that enough. It is definitely worth the money. You need an experienced advisor, especially, I'm all about, writing write the term sheet yourself, quite frankly. Create the document and then let them redline it. It sort of allows you to put a stake in the ground. But yeah, and you can probably get Claude to do that. When you're actually doing the deal, get a lawyer. Dilution that obviously comes around if you're doing Series A, B, C, and D. The pie is getting bigger, your piece of it is getting smaller, but it does compound over time. And like I said, you do want to control the company, I think, for as long as possible. But there will be times when that's not possible, especially if you are coming to the end of cash and need a bridge loan or something. Control is always at risk. But investors want board rights, drag along. Does everyone know what drag along it is? So if the company receives an offer to be acquired and one group of investors want to do it and the others don't, the ones with the drag along rights can pull all the other investors along, even if you don't want to sell the company necessarily. Information rights are pretty basic. I mean, you should be in the habit of giving monthly updates to your actual investors and your potential investors anyway about the milestones in your businesses that you revenue wins, new logos, any other significant breakthroughs that are happening. Investors don't want one deal. This is more specific to kind of the bigger projects, but it sort of plays into what I was saying about size. So they do want to be able to fund businesses that end up being big and end up being platforms. So even this business that I'm doing in Arizona, phase one is $250 million, but it's not enough for like a really, really big fund, say $15 billion sovereign wealth infrastructure fund, to be that invested in it. They want to know that you have follow-on projects as well, which we do. But, so the pitch is, I'm not building a fiber network in Arizona. We're actually building an infrastructure platform to enable frontier AI campuses across the US. And there's a whole bunch of them. As we know, power and land really power is a choke point. The US is blessed with a lot of places that they sit on aquifers. So there's 20 billion liters of water. There's, cool air out in the desert, but they're a long way from anywhere. They're a long way from the actual internet. So we want to be building the backbone to all that. But whatever you're doing, they just want repeatability, scalability, and a pipeline of things, whether it's, new products, new features, new markets. It shouldn't, and initially, because you're starting a business, it's always going to be narrow. It's always going to be that focus, but should at least in your pitch be nodding towards a larger platform. So if you are in, my trade is enterprise sales, which I started doing, and we have a saying which is time kills deals. You want to move quickly. You want everything ready. They don't die from no, they die from drift. I mean, VC's never going to tell you no. Have you noticed that? They don't like telling you no. It's like, come back when you've hit this revenue threshold. Come back when you've got 2 more customers. There's always some reason, but they never say no outright. But if you do have someone who's interested, I can't stress enough that you need to jump on it. You don't need to play cool. You need to jump on it. So respond fast, follow up, and be very aware that momentum is fragile. That means having everything ready, like your data room is ready to go. All the admin stuff, the customer contracts, employee contracts, insurance, deed of incorporation, all that stuff. Your financial model is looking slick. So one of the key takeaways, and it took me a long time to learn this as well, is have a really sophisticated financial model that shows how your business works over 5 years, and shows what effect adding capital does to that business in terms of returns. Have a base case, have a downside, and have an upside. Now, the investors will build their own model, but they'll appreciate that you've actually done it, and have, and that's one of the ways you signal that you understand that you're thinking like an investor, is that you've created this kind of model. So have that ready to go, even if it's a brand new business. Like, you must have a vision of, if you give me a $500,000 check, what will happen to our business? What will happen to that money? How will that be amplified over the next 5 years? Clarity. So this is what I mean about, writing your own term sheet. So have it ready to go.
Somebody mute that person.
Put your terms in. They can always push back, but always have that as a baseline. Know your next steps. So no one likes ambiguity. Like, especially some of these family offices, they've got deals coming left, right, and center. You need to have that ready to go. Momentum. So it's always hard getting people to move. There's always a reason not to do something. So it's, telling them, all the other investors, I have an allocation open for you. So I'm not asking for money. I have an allocation in my new equity round. I would love you to be part of it. But yeah, so, and it's like I said, with those updates, the signed agreements, the customer milestones, all that kind of stuff. And the access, make sure you're talking to the right person. Is it the partner? Is it the analyst? Is it the associate who is in the investment committee on Monday morning, advocating for you and making that decision? So always be aware of who you're actually speaking to. That's sort of fundamental to any enterprise sales. So just the playbook from day one, right? So think globally from day one, not as a last resort, but from now. So if you're sitting here in Sydney and you're thinking about creating a startup that is going to go beyond the borders of Australia, then you should start building relationships with capital providers in the US, in Asia, wherever, because you might not need them now, but you will. And it is much better to be talking to investors when you don't necessarily need the money. You just want to tell them about the business and be on their radar. very, very critical. But I couldn't stress that enough. Like if you have ambitions to be in the US, ambitions to be anywhere, start talking to investors in those markets. Go to those markets. You do have to be there and meet people. Most people are accessible. You spend, you're not going to get in front of Mark Andreessen or anyone like that necessarily, but plenty of people around Silicon Valley, plenty of people in New York, plenty of people in Miami. Even if you're that way inclined, there's all sorts of investors that are love to speak. Australia has a fantastic reputation. People like our startups. They're all looking for the next Canva. So match your story to the investor. So remember the different types of investors, even different VCs. So is your VC, a specialist in robotics? So if these are robotics guys, then that's fantastic. If they've never done a robotics deal, I find if you're having to educate an investor about your sector, then you're wasting your time. Like you don't need to convince them that robotics is the future. That you should be talking to people who are doing robotics investments all the day. Get that revenue in. Changes every conversation. Doesn't matter if it's a really horrible enterprise deal. Proving that someone will pay for your product is the best social proof you can. Structure your capital intelligently. So it really is so critical to get your fundamental corporate structure, how you structure your deals. Look out for the hidden clauses, dilution control, that sort of things. And then, move fast. Hesitation will cost you a lot more than a bad term. You just want to get a deal done. I think, I have a bias to doing deals. It's never going to be the first 3 or 5 deals, whatever. They're not going to be perfect deals, but they're deals. If somebody's willing to fund you, that's fantastic. It puts you already in the 1% of startup founders. So hugely important. I just want to end my session before you go to questions. So the challenge, right? So this is why I came here today. I'm really excited about, working with the incubator. You're trying to make an impact in your industry, whatever it is. But we're also, we want these companies because the Australian economy needs it, quite frankly. We've had a business model that's worked okay for about 200 years, but we need more diversity. We need more complexity. We need sophisticated technology-driven startups. It's fundamental to the next 50 years. So whatever you're doing, I hope it's successful. And I'm looking forward to hearing your questions. Thank you.
Awesome, guys. Do we have any questions in the room first? There's a couple online, but I'll just ask them
Excellent.
for theirs.
Yep.
I'll get you all to just speak into the microphones. That way the online audience is able to hear as well.
Hi, my name is Rohit. I was a bit late, but I looked at some of the ratios that you presented, IRR,
yes,
maybe LTV over.
Yep.
And you said that the values of those creates the difference between a lifestyle business and a VC. I think I might have an idea for a potential idea for a lifestyle business.
Mm-hmm.
Do you have any values for those where you say, well, these are some reference values where you look at that and you say, okay, well, here is where you are on a scale, and because that completely changes your strategy of funding?
It does. And what I mean by lifestyle business, right? So it's a term that gets thrown a lot around in Silicon Valley. It doesn't mean you're opening like a fishing tackle shop, all right, down on the coast, right? That's not what I mean. It's like a business that if they put $1 in, if they can't see a way to get $10 back, then they're not going to do it. So it's really just the magnitude of the return. So if they can see, I'll put $1 in, but I'm going to get like $3.80, that's not very exciting. That doesn't meet my IRR targets for my fund because I promise my investors a 15% IRR. There's an 8% hurdle rate. I don't get paid till I'm over that 8%. And that's how they get rich. But yeah, so it's nothing to do with the industry or the style of business. It's really just from a purely investment lens. If I'm putting capital in, what is my capital out? And typically that means I've got to get in software business, multi-$100 million, like 9-figure revenue. I have to be, globally expansive. I've got to have a marginal cost of revenue close to zero. It's like those sort of software business. But if there's a hardware business, if it's manufacturing, there's all sorts of different economics. But it really depends on what the investor can expect from their investment rather than the business itself.
And what kind of investors would we look at in the lower rung where you're getting maybe $3 for your $1?
Well, so yes, it really depends. I'd have to understand what your business is and so forth. But there's all sorts of different sources of capital, but it doesn't sound like that's institutional. But just hit me up afterwards. We can have a chat. Actually, while I think of it, yes, my contact details are here. If you want to you can add me on LinkedIn and so forth. So be happy to talk to any of you afterwards. Yes, over there. Oh. Yeah, I can hear. Yeah.
Hi, that was a really great talk.
Thank you.
So I'm the 3 decades alum of Cochlear, Abbott, Johnson & Johnson,
Wow.
MedTech commercialization. I'm now working in the MedTech startup space, somewhat new to Australia. And as I've met companies in this space that are going from a Series A or Series B, or plotting their Series A, one of the discussions that I often hear is we should seek capital not just from Australia, but from investors in the US or England.
Yep.
What are the complications or limitations for a startup that is incorporated in Australia to access institutional capital, VC money, out of the US or England?
Yeah, so quite often this is a well-trodden path, but yeah, you have an Australian entity, you've got to go to Delaware and incorporate, a C Corp. That's really the investment structure they understand. So you need the US corporation as and then the Australian company becomes a subsidiary, and that might own the IP. I mean, you can get into all sorts of fancy licensing arrangements. But yeah, fundamentally, you need to have the US entity set up. More often than not, it's going to be a Delaware corporation, and you go from there. And you really have to have a presence. I mean, it's fine to be in Sydney and want capital from California or New York or the UK or whatever, but you actually have to be there. I mean, the VCs don't really like driving too far down, from Menlo Park. Maybe they'll go to Atherton. I don't know, it's a suburb next door. Maybe they'll go to Redwood City, but they don't really want to drive too far, and so you do need that presence. I mean, and no way I would set up a company in California now, by the way. There's so many other states that would be more cost effective, Texas, Tennessee, Florida, really depending on your business, but you should at least have a presence in the United States and have that entity.
Great, thanks.
No worries. Yes.
Hi, and good speech, by the way, before. My question is kind of similar to his.
Yep.
In the sense that when startups happen in Australia, we typically get to a point where we hit a ceiling.
Yep.
And then we do have to seek overseas capital to expand and go further abroad. What are we doing actually to bring capital here rather than us going out to get it?
Well, and this is my point at the start, right? So there's an absolute ocean of money. So while I've been giving this talk, like $1 billion has gone into the Australian superannuation industry, like in the last half an hour. There's billions of dollars every day that pours in. So we have this huge pool of capital. I mean, I would be advocating, and I will be forever until they change it, to actually free up some of that for early stage investments. Because if we're going to have effectively the second largest retirement pool in the world after the US in 4 years' time, which we will, if the money keeps pouring it in, that's trillions and trillions of dollars. Then, for the good of the country and for the good of the amazing creative startups that we have here, invest some of that, even if it's 0.5%. I mean, CalPERS is great. It's one of the legendary investors. They will put, this is California teachers, they will put in even, couple of percent into early stage. It's not seed, maybe it's Series A, maybe it's, if you're talking about a company that's hit its ceiling, it might be B or C or whatever, real businesses. So we actually have the money here. That's the frustrating point. That's what I'm trying to make. Until then, yes, we have to go over there. But I mean, really, it's just, they're very, very conservative, right? That's the issue. But maybe it's a policy thing.
That was probably the next point I was going to make. Is our risk threshold in Australia is much lower than the US.
It is, yes, it is. It's very, very conservative. And, I think the failure, how failure is looked at is obviously culturally very different. It's a badge of honor. As long as people didn't get damaged and only people who could afford to lose the money lost it, you're not doing, absolute anything illegal, then people don't mind. You get in there and have a go. And it's like, yeah, well, this didn't work out. But, and I'll be honest with you, it takes 1 or 2 or 3 startups to get it right. Very, very rare is the story of starting a startup, everything goes right, I exited, I made $100 million, I changed the world. It almost doesn't ever happen. It's like, I started this company, I pivoted, we raised some money, it didn't work, we shut it down, but we learned this, and I took that founding team. And investors love the founding team. If you've been together for a few startups, that's really solid as well, taking those learnings. I think Lara has a question.
Thanks, Mark. In speaking to you earlier, as you mentioned, this is not your first startup.
Mm-hmm.
And you said you made some mistakes.
Mm-hmm.
Can you share some mistakes, earlier mistakes that you made?
Yeah.
You kind of go, watch out for this, for all the early startups here.
Well, I think, first mistake is just a profound ignorance of how it all worked. Like I said, like I showed you the thing earlier. So I just did corporate stuff, and you suddenly jumped into, well, what's a term sheet? What's Series A? I didn't know any of that. Right? I literally didn't know. And, you end up looking quite foolish. I think now there's a lot more knowledge around it. But, I think not if I'm talking about specific startups, like the revenue thing will haunt you forever. Like, you do whatever you can to secure that first customer revenue. Doesn't matter if you're losing money on it. You just need that deal. I think, don't be afraid to push back on investors when they're pushing terms on you that you don't necessarily like. You don't actually have to take it. I would be broadening my relationships much earlier with a wide variety of capital partners. I wouldn't be just going out when I need the money, but I would spend literally, like, your job. Number one job is to run the company. Number two is to make sure you never run out of cash as a CEO. So you're always, part of your job is talking to investors, whatever they are. You might need them in 5 years, you might need them next week, but always have that dialogue going when you don't need them, because the time was just, this is the update. Hey, we just won this customer, we just did this. So you need to be doing that. Yes, Peter.
Peter, my name's I'm CEO of Translink Communications. You talked earlier in your thing there that you had wins and you also had failures.
Yep.
As an entrepreneur, you've had a few failures and now got this new great idea. And you've gone out there to get the money. How do you fare with raising capital when you've already had a number of failures?
Well, I mean, so I don't talk about them in the pitch. That's I mean, people know. I mean, obviously, people respect seasoned operators. So I've been in business for 30 years. 20 years I've been doing startups and entrepreneurship. So, and by the way, I want to keep doing it for another 30 years. So I have a bunch of stuff that I really want to do. So, at my point, I know people because I've spoken to all the investors. There's no investor I haven't spoken to. Whether they said yes or no, I can call them and speak to them and ask, and say, hey, I'm doing this now. And so having a reputation, having people know who you are is vitally important. Doesn't matter if you necessarily, if it was a win or a loss, it's just like people, you're a known quantity, you've been in the industry, you're operating, people know who you are. So I'm not going to people for PMC Fiber in Arizona that I've never spoken to before. Like I'm working with a boutique investment bank for some of the structuring of it, who I've worked with for 5 years. So know who I am. They're introduced me to family offices that they know and trusted relationships. All the infrastructure funds I've spoken to, I've been pitched. I've either been rejected or accepted by them, but they know who I am. So you get to a point where if you've been in an industry long enough, and this is what I mean, like if you don't make it the first time or second time, it doesn't really matter as long as people see you there operating. As long as you're being honest and integrity is, vital to what you do, then people will probably take your call a second time. Hey, Peter, this is what I'm working on. And then you go from there. But I don't think it doesn't, having a loss or a win to your name doesn't really matter in the US, especially.
Yeah, Adam. Yeah, we've just got some questions online. So we've got Brenda who's asking, they're puzzled about your comment about not worrying too much about the financial amount that you're trying to raise, without being clear on your finances, how much you need and how you'll use the capital. How would you be credible in front of investors? Yeah,
I'm not sure that's what I meant specifically. So no, you should be absolutely 100% clear on the amount of money. That's why I said you should write your own term sheet. I was probably referring to in that comment the amount of money that you're going to make personally as an investor. I think be relaxed about that. Like, as an operator, as a startup CEO or an employee of a startup. In your first couple, the number one goal should be getting funded, creating a business that lasts, getting to some milestones and so forth. if the difference in the term sheet is between, your theoretical return of being, $1 million or $5 million, that's what I mean. Don't get hung up on that, especially in the early stage. Later on, if you've been doing it for a long time and, you have financial goals you want to meet, that's fine. But don't get caught up early on in making a ton of money as your first priority. Obviously, you should want to make money, but not as a goal. Yeah.
Yep. We've got one from JP. He said, I've heard from founders that some VCs will take meetings and build up a pipeline of companies they're interested in before their own fund is actually closed. That ends up burning a lot of founder time on conversations that can't go anywhere. How do you suggest founders identify whether a VC actually has capital to deploy right now? And how do they navigate that conversation without damaging the relationship when the fund does close?
Yeah, no, that's a very good question, JP. And that's, it's fundamental. You don't want to waste time, but there's nothing wrong with asking. And this is what you should do as part of your diligence with investors. Hey, is your fund ready to deploy capital? Are you in year 8 of a 10-year fund? Like, do you have any capital left? But there's nothing wrong with, and you should be able to tell, look at, there's various sources of information. If you're going to see a VC, you should see if they've announced the fund, the age of the fund. So if it was a fund from 2020, it's probably over halfway through, and they probably don't have much capital left to deploy. They're probably just doing follow-ons at that point. If it's a fund that's like nearly 10 years old, they're not going to invest. They're going to be looking to, and you do take an investment from them, they're going to be saying, hey, we've got to return our capital now. So you're for sale and you might not want that. But yeah, no, you just be upfront with them and ask, and it's perfectly fine. They're doing due diligence on you. You should do due diligence on them as well.
We've got 2 questions related to kind of international investment specifically.
Yes.
The first is most Australian startups seeking investors from the US don't know where to start.
Yes.
For suggestions there.
Yep.
The second one is, how do you get help on export licenses for products to be exported to Africa and Gulf regions?
I don't know. So that's a great question. That's a very specialist question. I've never done it, but I'm sure you talk to Trade Australia, we have great government agencies who will help with stuff like that. So what was the first part of the question was like, how do they get started?
Yeah. How do you get started seeking investment from the US?
So it's pretty clear. So if you're in an industry, let's just pick an industry, right? Just say, I was talking about robotics before because I was looking at a robotics startup, but just say you're in robotics. So there are a dozen robotics investors in the US. It's their thesis. You can see the investments they've done. You can see the style of business they've done, and you just reach out to them. It's a business development activity, right? So I want customers. It's the same process. You cold call them, you email them, you get them on LinkedIn, you go to conferences, you send emails, you give them up. And, their job as investors is to look at deal flow. So you want to be on their radar. It's, they're probably happy to do a Zoom with you maybe, but, your outreach should say, hey, this is my company. This is what I'm doing. We're actually going to be in Silicon Valley for 2 weeks in May. Would love to catch up if you got some time. So you really have to do, but I think because the investors are so sector specific, you should be able to narrow it down pretty quickly. And there should be peer companies that you like, and then you just go after them. It's just a good old fashioned business development.
Hi.
Hello.
My name's Sean. If some founders or business owners coming from Asia to here to raise fund, probably finance or mining sector to raise fund, as you said, we have the second largest retirement pool in here. So what advice would you give them, those founders?
So for Asian founders coming here from China or from Yep. Well, that's great, and this is what I sincerely want from Australia is to be a destination for overseas founders who come here, because there's an ecosystem, because there's capital available to them. But so you also have the advantage if you're coming from Asia, then you're going to bring some Asian relationships with you. That's critical. But it's the same as going the other way, right? If you're coming to Australia, you have a specific sector. We have a very small and concentrated VC market. It's there's a spreadsheet floating around with them all on, I'm sure, and what they do. What their last 5 deals were. And if that aligns with you, so if you are a Series A robotics firm, looking for $1.5 million, there'll be a bunch of examples that you could see and and talk to that company as well. That's the other thing, right? So when you're going to the US or coming here, if you like an investor, talk to companies that they've invested in. So the other startup founders will more often not be happy to speak to you, as long as you're not like a direct competitor or anything. But there's I think a good community around that, and you shouldn't have any worries reaching out to people who are in your industry and who have that investor.
How do you position yourself in reaching out to VCs that have a direct competitor of VCs?
Yeah, so the question was like, how do you reach out to VCs who have a direct competitor? And I think very carefully. I mean, obviously, quite often they would love to have a look inside your data room and so forth and and run away with that. But just reach out, be very careful about the information you share, see what they say, but you can obviously spend a lot of cycles not getting anywhere and divulging a whole heap of information. It's more just like, if you're in healthcare or if you're in robotics and so on, there's such a wide scope within that industry, right? So if you're like a one-on-one head-to-head competitor, I'd be very careful. But if you're adjacent, thematically, this is the same industry, I wouldn't have any worries about it.
Hi, I'm Gaurav. I just wanted to understand, you said that you need to have a subsidiary in US, let's say, if you want to raise from there.
Yep.
So let's say if there is a business which is Australian based only for Australia, do you think there is an opportunity there as well?
I think it would be a struggle if you are not planning to go overseas to be looking for US capital. They'll struggle, I think, in understanding that. And when you do the flip up, it's called what you should have the Australian company becomes a subsidiary and the Delaware corporation becomes the parent company. But no, if it's just a local company that doesn't have a market outside Australia, I think US VCs, like I said, they want to be in a 6 square mile radius of Menlo Park typically, and for a company that's not doing anything outside would be
so. So there are different stages, right? So first you basically conquer one region and then go out, right?
Yeah.
So let's say there is a company who's basically they're dealing in Australia at the moment.
Yep.
They have the plans.
Yep. If they've got the plans, and if your fundraising story is actually I'm raising to go global, then that's a different story. Absolutely. So if you've got an established or a business that's functioning well here and you want to replicate and grow, then absolutely that is fundable.
Without subsidiary.
Oh no, you'll still need. I think you'll still need a US subsidiary. Yeah.
All right.
Yeah.
So typically, before even moving out of Australia, you need to establish something and then go.
Yeah, you can do it online for like $79 or whatever. I mean,
all right.
Yeah, it's not hard to do, but then that does obligate you to filing taxes with the IRS, and you have to report everything globally. And it's not as simple. Yeah, you can do the paperwork, but there does become a bit of an admin overhead for you.
Sorry, another question follow up. What do you think about accelerator versus angel versus VC? So these are different kind of milestones for each company, but
look, I think it's all good. What ultimately matters is, do you have a product and can you convince people to pay for it? That's really critical. I think there's these frameworks, accelerator VC, they all come with slightly different financial strings attached and different things, but I think they're great. Like, why not? If you can get into them and they're not egregiously asking for 40% of your business for $100,000, then yeah, absolutely, why not? Well, yeah. So that's kind of what I was getting at. So what are you going to learn specifically from that incubator or accelerator, or whatever, that you can't learn by doing your own research, by spending a couple of weeks in California, by reaching out to peers in the industry? What is the value add, I would ask. But if they come with specific investor relationships, maybe I would never pay to be put in front of angels or anything. I don't like that at all. I wouldn't do that. But I think I would open it if it was a fair financial deal for you. Hello.
Hi, I'm Janice. I'm from PHCC, and I wonder whether you can help us with matching. So because so many VC and angels that we need someone who may have some specific requirement or criteria that match what we already have, or in case we don't, as you say, we no one want to waste time. So we want to know before we actually find there to meet them. You know? Yeah. In case they ask for the equity that we can't offer or something, yeah, I would like to hear.
Yeah, I hear your point. I mean, it is a labour and time-intensive process. You know, the fundraising process. I don't know if there is necessarily too many shortcuts, but I mean, hit me up afterwards. I might have some ideas for you.
We've got a question up the back.
Yep. Yes.
Is this on?
Yes. Hello,
Mark. Thank you for the chat. It was really good. So my business has always generated revenue from day dot, but the amount of revenue it generates is dependent on how much time I can focus on the actual, selling the cars or whatever.
Yep.
It doesn't make it scale.
Yep.
So when I speak to a lot of investors, it's like, oh, what's the growth? How's it going? And it's like, well, it's not growing because you're stuck in the same spot.
Yep.
How, like I'm saying, it's a 4-year proof of concept. We've been, doing it that way. I don't know how to answer that question when it comes to, an investor about, why is it not growing, so to speak, even though it's generating revenue.
So you're 4 years into it now?
Yeah.
Yeah, and you've been making money for 4 years.
Yeah.
And you want capital to
scale. Because it's only me doing everything. We've got the software to roll out nationally, clients to get nationally. We've got national, corporate clients that we need to engage. And we basically created our own sort of lead channel that using employers to generate leads as employees for buying new cars. So it's a complete new distribution channel, but it's not one man.
Is it so? If you got capital, would it like 10x the size of your business or 20x the size of your business? I think that's a real question to ask. Is okay, it's like this, and I'm only constrained by capital. But if I had this money, I'd actually be able to create 10x. If that's the case, then you're not probably talking to the right investors, because that's a really good story, quite frankly. So there's product risk, execution risk, and people risk, essentially. You've taken away the product risk and the execution risk because you've proven that there's a demand for your product. Your product is the one that's satisfied. You're the one who's doing it. So what you're asking for is fuel to put on the fire. So it sounds like it. I don't know the specifics, but it sounds like there should be conversations for you to have.
Yeah.
Quite frankly, yeah.
All right, thank you.
Hey there, thank you. I'm Spoon from Spoon's Voices. We turn content into inquiries to help businesses grow.
Yep.
I wanted to really just ask you quite simply, from what you're seeing right now, what's the biggest gap between businesses that think they're ready for investment and the ones that actually get funded?
Yep, that's a great question. So everyone thinks they're ready for investment, but there's like the things you need, like I mentioned, like having the data room ready to go, having your financial model looking really good. Wall Street level of Excel spreadsheeting going on there. That's really, really important because they will look at that. The customer story is happening. So you obviously have customers, they're paying, you have a real story. So I think, just getting those hygiene things ready to go is really, really important. And then being super clear about what you want. So if you want, what stage are you at now? Yep.
Originally from the UK,
yep.
Just come to Australia, and we're noticing a pattern of brands really not doing the most they could with social media.
All right.
So our thing is to help them turn their content into inquiries and grow. So we're interested in seeing what the landscape offers us in that sense.
Yeah. Well, look, it sounds like you've got a proven business. That's excellent with 15 years of trading history. So it sounds like you would be ready. So what are you looking for? Are you actually looking to do a round, or?
We're open. We're open to it.
Yeah. Well, it sounds like you're ready, but the companies that aren't ready are people who, are still figuring out, the terms that they want, still trying to figure out. You can be pre-revenue, but if you're pre-product, maybe that's a little bit early. You should have some sort of proof of concept ready to go. But you sound like you're off to the races. Probably time for one more.
A couple more. Would 2 more be all right?
Yep.
So we've got one online.
Yep.
We have a solution that works across the investment value chain, but tackling international investors first. You mentioned investors like to see future product rollouts.
Mm-hmm.
However, we get pushback from startup courses in Australia that VCs are interested in have a narrow focus. I suspect the sweet spot is somewhere in the middle, but please can you expand on that, particularly when approaching fundraising in the US, Singapore, and the UK?
Yeah, no, that's a good question. So there's nothing wrong with having a roadmap, I think. So that's a key thing. So yes, if you're a 5-person startup, you want to be trying to do one thing really well. Like that's most companies are going to be 3 people in a room doing coding, doing everything, doing marketing. So of course you're not going to have a massive product suite and so forth. But I think so. Talking about the scalability and return on investment, you should have a general plan and outline of how it is going to look over the next 5 years. How you do get to like a massive business is really, really critical. But there's nothing wrong with actually having a roadmap. But yeah, in terms of what's practically possible, you have to have a narrow focus just because you're resource constrained. But that doesn't mean your deck can't elaborate on what the big picture is. Yes, sir.
Thank you for the insight.
Welcome.
My question is, what impact will US-Iran war will have on investment landscape globally, considering there is a recession and things like that?
Oh, it's a very challenging question, and I'm not sure I'm qualified to answer it though. Thanks for asking. If I did, I'd be shorting or long on all sorts of stocks and oil and stuff, but I don't know. But I tell you what, so there's always going to be a war. There's always going to be a recession. Oil will either be $90 or $150. As startup founders, you just have to learn to operate in whatever the market is. There's so much you can't control, so you just got to be comfortable with it.
Do we have time for one more?
Yes, one more, absolutely.
I think this gentleman up here had one.
Yeah.
Just wondering about investors that you've said no to, or terms that to steer away from. Any that stick out in your mind?
Just egregious liquidation preferences. I think that seems to be more common in Australia than not. But having a 2x or 3x liquidation preference is ridiculous. You don't want to. You've got to be careful as an investor. You want the founders to be incentivized and motivated to keep building the business, right? You don't want to crush them under ridiculous terms. So yeah, that's one thing I would watch in your. But it really depends. If you are in a situation where you're running short on cash and your options for getting bridge or a dreaded convertible note, they normally come with nasty terms attached if you have no other choice. So it's really about having optionality, having some revenue. Excellent.